Hello everybody and good day, and this is the last week of our sessions for this particular course. So, what we will try and do today in the last class, if you have last week if you had actually seen, what we did was we did a quick recap of whatever we had covered so far, that is week 7. Now being week 8, what we will try and do is we will try and get to the closure of this entire course out here. So, how are we getting the closure out here? So, what I am trying to do is we are trying to look at basic aspects out here. We will actually do what we call it as typically the ratios. Basically, when I say we will do what is called as analysis of the whole thing, we will do what is called as the ratios out here. So, when I say ratios, what do you mean by ratios? Why do we need to do ratios? What is it that we are trying to do? We are trying to look at what you call it as analyzing what you call it as the health of the company from various perspectives. What are those various perspectives for which we are analyzing the health of the company? Let us say you look at something like what do you call it as a debt provider, or what do you call it as an equity provider. They need to analyze the health of the company to know what is whether to invest or not invest. I will basically say capital provider. I need to look at what you call it as a vendor to the company. He needs to analyze the health of the company in order to get his money back. Now, what do you call it as? This is basically what we call it as. You know, what are the aspects that a vendor will look for? Basically, what I am trying to say is every stakeholder is looking at analysis of this company's financials out there for various aspects. Let us start with what do you call it as typically. Let us, if you have to look at it, let us look at this particular annual report, that is the consolidated financial statements of Maruti Suzuki, what we took for our analysis. Let us take that and then let us try and see if we can analyze it. If we look at it from what do you call it as the vendor perspective, I am looking at, let us first look at from the vendor perspective. Now, if I have to look at it from the vendor perspective, I am just going to do it. What does a vendor typically look for? A vendor means a supplier. The supplier will always look for one basic aspect, that is, when will he get his money? Or whether he will get his money. Now, what are the aspects do they look for? How does a vendor get? Now, what happens when you buy goods on credit? What happens? There is a creditors in the balance sheet which increases. When you sell goods on credit, what happens? There is a debtors balance and the balance sheet which will also increase out there. Now, how do you pay these fellows, the creditor fellows? I pay the creditors fellows from basically my, what do you call it as the, when I collect money from the debtors, I basically pay them. Basically, what happens? I am taking care of what do you call it as my current liabilities with the help of my current assets out there. That is, my current liabilities will be paid up by my current assets out there. Now, I need to know, basically, this is what we call it typically as the liquidity of the company. Liquidity. How liquid? Is there enough amount of liquidity in the company for the company to take care of what do you call it as the current liabilities? I repeat, is there enough liquidity in the company to take care of what do you call it as current liabilities? So, what do? You normally do what is called as current assets by current liabilities will tell me that. Now, let us look for Maruti Udyog for the year 2018. What are the list of current assets out there? The current assets for Maruti out here, the balance sheet what we took was about 79,300. What are the current liabilities out here? The current liabilities were 154,485. The process. Now, if that is the case, now what does it lead to? It leads to basically a current ratio of 0. What do you call it as 5133. I mean to say that your current liabilities are more than your current assets out there. Now, do you want to say, oh, is it good, is it bad, etc.? I am not going to give you a number of what is a good number or what is a bad number, etc. out here. It depends on the policy of the company, which we will see as we go along. We will see that further. In this particular case, the current liabilities might be more because for a simple reason that you might be selling goods on cash and whereas you might be purchasing on credit. Then what happens? Your creditors balance in the balance sheet, liability side of the balance sheet will be very high, whereas there will be no debtors out there. One can argue if there are no debtors, there will be cash because you are selling on cash. No company tries to keep cash, liquid cash. What they will do, they will move to the next level. That is, they will move to one level above in the balance sheet, and they will basically park the money somewhere or invest the money. And then what happens? Your cash balance will normally, your debtors will not be there, and basically cash is invested out there, so your current assets per se might be low also. Now, normally it varies from industry to industry. It varies basically depending on the policy of the company also. Now, look for 2017. What is this ratio out there? If I look at 2017, my current assets was 87,980 was my current assets. My current liability in this particular case was 132,368. I'm sorry, 368. That basically gives me what do you call it as 0.664. So what are we trying to do out here in this particular case? We saw that last year the current ratio was liquidity was about 0.66. This year my liquidity has become 0.51. So what does it signify? More or less the company is maintaining what do you call it as a negative current, what do you call it as a negative working capital requirement in this particular case. What do you mean by working capital? What do you mean by working capital? What do you mean by negative working capital, etc.? Let us sort of spend a minute on that. When we say working capital is nothing but the money that is required for the day-to-day operations of the particular company. Now, what is it? How do you manage that? The difference between what is called as my current assets and the current liability is what is called, we call it as a working capital requirement. Now, why is this current assets and current liabilities out here? Please note, all your current assets out there, basically what it has to be financed. That is uses and what do you call it as sources and utilization of fund. Go back and then recall that. Now, if all these has to be funded out there, basically how it is funded? It is basically funded by my current liabilities. Very simple. I buy on credit, 30-day credit. I do what is called as manufacturing, and then I sell on 15-day credit. How am I able to sell on 15-day credit? I am able to give the goods, not receive the money, because I don't have to pay this fellow. This fellow, imagine the processing time is another 15 days. So what happened? 30-day credit I bought, 15 days I spent on manufacture, I'm selling on a 15-day credit. So what happened? The day on which I get the money back here, I'm going to go to pay this fellow out here. So in that sense, I am basically taking care of it. That is, the day on which I am getting the money on this sale, I will pay what do you call it as the buyer out there. So what is called it? This required. Supposing it says instead of 15-day credit, you are also selling on a 30-day credit out there. Then what happens? Once you buy the goods, you need 15 days to manufacture, you need 30 days to get the money, you need about 45 days, whereas your money falls due for 30 days out there. At the end of it, 30 days you have to pay for the buyer. So what happens? For 15 days, you need to borrow money, that money out there to pay out there for 15 days out here. Now that is what we typically call it as a working capital requirement out there. In this case, because the current liabilities are higher than the current assets, what you have what is called as a negative working capital in this particular case out there. Now to move further, in the liquidity ratio itself, what we sort of looked at out here, there is what is called as further refinement of this liquidity. That further refinement of this liquidity is basically called as quick ratio. What is this quick ratio? That is, all the current assets are liquid, are easily converted to cash, perfectly all right. But there are certain current assets which can be relatively more stickier. When I say relatively more sticky, I mean to say that the ease of that conversion may not be very high. Now, what did we see? We said that in the last, I think in the week 6 also, somebody had asked me this doubt, and I tried to clarify this. Normally, I will say inventory is the most sticky form of asset. Somebody argued, no, it should be accounts receivable because I am not receiving the money. Please understand, when you have sold goods on credit and when you have to receive the money, you can always do what is called as discounting, which I explained. You can always do what is called as factoring also, which I basically explained in the process. That is factoring. What is factoring out there? Factoring is nothing but I can sell all the receivables that I have out there. There are Can Bank factors, there is SBI factors. Nothing. Imagine a situation where you ought to receive about 10,000 crores. Now, I need to receive on an average 10,000 crores 3 months down the line. Now, but whereas I need money as of today. So what do? I will sell all the receivables from the books to a factoring agent. My factoring will give me 9,500 crores out there. The other 500 crores he might keep for his cost because of the 3 months later only he's going to get, and as well as factoring cost and everything. 9,500, 9,700 crores I will get. So that money I am getting as of now, then once I get the money, the receivables are not there in my books anymore. The receivables are not there in my books anymore. And then what is there in my books is cash. I have sold it. Question. Supposing the person who has bought these receivables is not able to collect the money, then what happens? Please note, in India, what we have is only recourse factoring. When we say recourse factoring, if he is not able to collect the money within the reasonable period, he will come back to you, collect, give the bills out there, collect 10,000 crores, not 9,500 and 9,700 what he gave, because 10,000 crores plus what is called as damages for his effort out there. That is what he will collect, and that is what recourse factoring is out there. And in India, what we have is we have recourse factoring, and let us stick to that out there. So what happens? That is easier asset out here for you is receivables. Inventory is normally the most stickiest form of asset what you basically have out there. So now let us look at what is the quick ratio in this particular case. Quick ratio in this particular case is nothing but 79,300 minus what is called as the inventory out here. In this particular case, it is 31,602, and then whatever is your current liabilities, what is your current liability? Current liability is 154485. So it is nothing but 154485 out here. So that is equal to basically in this particular case, that is about 0.3087 out for 2018, and for 2017 it is nothing but I'm just going to do it again. That is about 87,980 minus 32,637 637 divided by my current liabilities, which is about 132,368. That gives me a current ratio of about 0.418. So what am I trying to do out here? In this particular case, it was 0.41, it has moved to 0.30. All these things do not make much of significance out here, because your requirement per se is working capital per se. What you call it is you have a negative working capital in this particular company, so not much of an issue. So you need not really bother much about it in the process. I will explain this as we go along further out here. Now the next thing what he is worried about, and the liquidity of the company is fine, but he is also worried about on an average how long does your company take to pay or even receive. Why? Because only if you receive you will pay. So on average, how long does it take for you to receive? On average, how long does it take for you to pay? The company is normally worried about these kind of things also. So what do you do for that? How do I know on an average what is the how long do you take to receive or how long do you take to pay, etc. Look at a very, very simple aspect out here. Look at what do you call it as a very, very simple aspect out here. Now, let us say, what is the sales you have? Let us look at how long do you take to receive? How long do you take to receive? Let us look at what is the sales out here. Here, when I say sales, I mean only what do you call it as, I am not looking at the other income, I am looking at only what is called as revenue from operations. Revenue from operations is 820, 411 out there for what do you call it as 2018. So my immediate question out here in this particular case out here is, on an average, if this is what is your sales, what is your sales per day? Let us consider 360 days in a year out there. As of now, you can consider 365, that is up to you, or you can consider 300 what do you call it as 350 also. So that is not a problem. I leave it to you. So normally it is about considered 360. That is, we find that on an average you have about, your sales is about 2,279 million dollars is the sales per day. Now, on an average, what is the kind of receivables you have? On an average through the year, what is the kind of receivables you have? What is the kind of receivables you have through the year? On an average, I'm just looking at the average out there. When I say average out there, how do you know? So, you might immediately argue, oh, I don't have the data for every day, so I cannot find the average receivable. Now, let us look at it. Let us look at even a simple average. Let us look at what is the receivables at the beginning of the year and at the end of the year. Let us take that. Beginning of the year receivable will be, what is the receivable in 2016? Obviously, that is 2016. End of the year 2016 is beginning of the year 2017-18. So, 16-17. So, we have taken what is the beginning and then what is the closing inventory. Closing inventory is about trade receivables, I think. Yeah, trade receivables. I think I am just going, yeah, 12,206 and then 14,654 divided by 2. That is 12,026 plus 14,654 divided by 2. Basically, average is about, my average receivables is about 13,340. I want to know this average receivable what I have, is equal to how many days sales. All that I do is, I will say 13,340 is the average receivable what I have per day. My receivable is 2279, so that is what I will just do it. I am looking at, normally I take about 5.85 days to receive money on the sales that I have made as far as 2018 is concerned. As far as 2017 is concerned, let us see that what is the sales in 2017. If I have to look at what is the sales in 2017, I am just comparing out there. If I am looking at sales in 2017, it is 777,773, sorry, it is 773,164 divided by about 360. Sorry, I'm just going to color it differently out here. Okay, 773,164 divided by 360. That is about your per day sale on an average is about 2148 million out there. And let us look at your average, what is called as receivables out there. Your average receivables opening figures means you will have to go to 2016 figures also, because 2016 figures also, I looked at one more year's balance sheet, and then this is the closing figure, and then opening figure I have 13,234 is what I have. That is this, I am getting this number basically from 2016 balance sheet. I am getting this number from 2016 balance sheet to 6 plus 13,234 divided by 2. That basically is about, my average is about 12,630 is my average out here. So all I'm going to do is 12,630 divided by what is called as 2148 is what I'm going to do to get this. I will say my average was about 5.887 days out here. Average time that it takes for me to receive is 5.87 days. This year, current year, it is 5.85 days. Last year, it is 8.57 days. As I told you earlier itself, you are not selling much on credit. You are selling more and more on cash. That is where your receivables are so low out there. Let us look at the receivables are fine. Then now let us look at what is called as the payables out there. The number of average days it takes to pay. Fun, when you buy, what do you pay? You on what you buy, that is on what you buy only you have to pay. What is it that you buy? That is, I look at what are the cost of material that is consumed out there. In 2018, in 2018, if I look at what are the cost of materials consumed, cost of materials consumed is about 432 is the cost of materials that is consumed. On average, how much do you consume per day? On average, I consume about 1,248 million rupees worth of material out there. Now, on an average, what is called as average? What is the creditors out there? Again, I just do the same thing. Average creditors, I take the last year creditors, I take the current year creditors, I just divide it by 2. If I have to look at what is the last year's creditors out there, I'll have to look at current liabilities, total payables and total outstanding out there. Total payables in this particular cases, yeah, for the current year is 711 plus 104282 is the current year's payables. Last year's payables is 832 plus there are 2 parts. Payables are split into 2 parts here. That is why you have number 82860 divided by 2, because these 2 pertain to 1 year, these 2 pertain to the other year. So if I look at 711 plus 104,282 plus 832 plus 82860. That is on average. My cost of average my creditors is about 9,409,4342 is what I have. Now all that I do is number of days it takes to pay. Number of days to pay on an average I take is 94342 divided by 1248. That is basically equals to, you take about 75.6 days to pay out there. As I told you earlier itself, that is where you have a negative working capital. What do? You buy on credit. When you sell, you are not selling on credit. You are buying on credit and basically you are selling on cash out there. So number of goods on the amount you have to receive on the sale is only 5 days. Whereas the amount you have to pay on purchases is about 75 days, what you see. That is where you have what is called as a current asset and current liabilities, current ratio less than 1, because your current asset is very, very low. Now, is it a policy of the company, or is it good, is it bad, etc.? You might ask me 100 questions out there. I'll come back to all these questions out there. Let me calculate the same thing for 2007. I have some data of the old data, what I basically have of the days payables also, that is previous year's data I will have. So what I'm just doing is, in this particular case, I am looking at what is the cost of material consumed. The cost of material that is consumed is the cost of materials that is consumed in this particular case is 426,279, 426,279 divided by 360, that is equal to 426,279 divided by 360, that is per day. On average, you consider about $1184 million worth of material. What is my average inventory? My average creditors out there. My average creditors is about, I have some figures of the previous year also, that is 1, 2, 0, I think, yeah, I'm sorry. Yeah, these two put together, I've got a total out here, 83, 692, these two put together, 83, 692, plus the previous year's figure, 533, plus, what do you call it, 73, 556, 73, 556, I'm sorry. Okay, 556 out here divided by 2. This basically out here, this is these two figures put together is the same thing out here. So it is 83 692 plus 533 plus about 73 556, 73 556 equal to divided by 2. That is basically average creditors is about 78890 is the average creditors out there. How many days does it take to pay? 78890 divided by 1184. 78890 divided. That is equal to, you take on an average about 66.6 days to pay out here. You can see this very clearly in this particular case. You were taking 66 days last year to pay. This year you are taking 75 days to pay. You have increased your payment time, whereas when your collection is on 5 days out there. So what happens? Your current ratio will be low. Your working capital requirement is low. Policy of the company, yes, it could be. For example, very simple. How do you look at Amazon? You make a purchase on Amazon, Flipkart, Snapdeal, whatever it is. What do? You first pay by your credit card or bank transfer, and then the goods come to you. And whereas you do, or the other option you do is you do cash on delivery. So when the goods are delivered or the goods are sold, payment is made to the company. Now, when does Amazon or Flipkart pay their supplier? If you actually look at on an average, the days now you look at, based on one of the cases what you look for Amazon, it on an average takes about close to about 200 days to make payment for its suppliers. Whereas they are getting money on the sale immediately, whether cash on delivery or purchase and pay and order. Whereas the payment that takes place basically is about on average about 150 200 days out there. So what do you do with the money? You are parking it somewhere. If you are rotating the money, you are parking it somewhere out there. You are making some investment, and that is also yielding a substantial amount of revenue for these companies out there. Is it good? Well, if they are able to operate that way, that is the best way to operate. That is all. Because ideally, you run the business with somebody else's money. That is what they do, and that is the best way to do it. Do business also. But is it always possible? That depends on your policy and your muscle, your power to in the market to sort of take care of all these kind of issues out there. Right? We are not getting into that. Next, the third part of liquidity part of it, what we look at is what you call it is how long does inventory stay in your company? How long does inventory stay in your company? Same thing, not much of difference. What do you do? Well, that is, you get raw material. I mean, I presume when I'm talking about inventory, I'm talking about raw material out here. You get raw material. How long does it take for you to stay? When inventory enters your godown, how many times does the inventory get turned over, or how long does the inventory stay in your godown out there? Simple. The same way, average, or what do you call it as, what is the normally, that is, what is the per day consumption of material? We calculated it for 2018, we calculated it for 2017 also. I will just go and then get the figures from here. 2018 is about 1248, and then 2017 is 1184. 1248 and 1184 is basically the average consumption. What is your average inventory in your company? Please note, I am presuming everything to be what do you call it as raw material inventory. What is the average inventory? Let me look at my inventories out there. My inventory is about, in this particular case, is 31602. average inventory 32,637. That is basically I am talking about average inventory in this particular case. My average inventory in only is about 32,119 out there. If this is the average inventory and this is the kind of consumption what I have per day, then how long does it take for me to consume this out there, consume this inventory? If this is the average rate for which I am converting, I'm consuming out there, I'm basically looking at consumption out there, that is 32,119. So on an average, how long does the inventory stay in my company? On an average, my inventory stayed for 27.5 days out here is what we basically see as far as 2018 is concerned. I've done the same thing for 2017. I have the average data, average material or inventory data I will have, that is 32,637 plus 2016 figures I have 31,326 divided by 2. I'm sorry, divided by 2, that is basically gives me an average of about what do you call it as 32,637 plus 31,326 divided by 2, that gives me an average of about 31,981. And then what is the consumption per day? Consumption per day is 1184. That is, you are normally taking about 27 days. The inventory that comes into your company, basically the inventory that comes in your company, basically it takes about, what do you call it as 27 days last year, and this year it takes about 25 days for you to consume what do you call it as inventory, it get consumed out there. That is the time of, see what happens, what is the idea, what is the advantage of this? If the inventory holding period is long, that means what is happening, there is a money that is getting blocked out there. You are purchasing inventory and then it is not getting converted to finished goods and sold. If the money is blocked, then that needs, you need more and more working capital requirement out there. So as less amount period of time as possible, the money is blocked, that's good for you because the inventory holding is low. Your receivable, you are selling on cash, your receivables are low, whereas your payables are high. That is the best kind of situation where you will have all the money for yourself out there. Am I with you? Fine. Now from here we move on to the next stage out there.